We start today's market talk. Whether the center's fiscal push will be enough to address external uncertainties, this is the big question right now because we have seen a fiscal stimulus, rating upgrade is against global uncertainty, tepid earning growth, expensive valuations, and FI selling. Now, these are the counter things which are playing out. So right now, can lower point of sales taxes achieve what lower income tax could not? Because if you remember, the government had lowered income tax in budget this year, but it didn't achieve anything in terms of consumption. So for investors, Nifty earning growth is expected to be in high single digit in FY26 and valuation at 22 times 1 year forward is at premium to long period average. So we are expensive right now without earning growth. Now, market outlook. US stocks soared after Powell's speech signaled interest rate cuts would be on the horizon. Powell said that with policy in restrictive territory, the baseline outlook and the shifting balance of risk may warrant adjusting our policy stance. So we had one eye on the risk posed by Trump's reciprocal tariffs to prices, but softening job market is also a source of concern for him. His base case is that inflation effect will be short-lived, so Fed has chosen to address the problem of jobs and to provide support to employment. A September rate cut will lead to lower interest rates for consumers and businesses, so the effect of higher tariffs on household budget and corporate profits can be blunted by cheaper money. This is his thought process. So net result was US bond yields are down and their equity markets rallied, gold was up, cryptos were up. So everything is doing well out there. Now, the second issue is government's push to boost the domestic economy by lowering GST rates. So if you see here, uh, proposed GST rationalization could be an additional fiscal stimulus, right? So right now, what is being talked about is that 12% and 28% will get removed and moved into 5% and 18%. Switch off your volumes. So the 5%, so if you see in the share of total revenue, around 16% is in only in 12% and 28%. So net impact will be around not much. The other point is, what are the items taxed at 28%? Two-wheelers less than 350cc, two-wheelers higher than 350cc, but along with 3% cess, three-wheelers, small petrol cars up to around 1200cc, small diesel cars up to 1500cc. Bigger cars than this are at some 42 or 43% GST. Commercial vehicles, air conditioner, TVs above 32-inch, dishwasher, cement, etc. So the other doubt is that how many items they would be able to really effectively move out of 28% slabs into lower slabs. So because they are also talking about a kind of a luxury rate of around 40%. Now, which are these luxury or the sin items we'll have to still see. So what we have seen till now is that urban consumption has been ailing and proposed GST cut will help. GST Council is going to meet on 3rd and 4th September to discuss the recommendations of various groups of ministers. Government need to implement these changes quickly in time for festival season demand. Otherwise, it would deal a blow to sales and earning in a crucial period of sales. So that is good that after whatever GOM has decided, these guys are meeting quickly to sort out this thing and not letting it just prolong. The other point was significant decline in sentiment towards India's stock market among global fund managers who have shifted from viewing it as the most safer market in Asia to the least preferred. Now I'll show it to you again. You see from if you see from December 24 to current, this is the amount of movement in all other the big markets, top 10 big markets. If you see Germany, Hong Kong, nearly 50%, Canada, UK, China, France, Japan, Taiwan, US, and India. So we are around 3-4%. So we have not moved much in terms of market capitalization. So the others are performing very well once they have sorted out this tariff issue with the US. Uh, why this market confidence is down? This is due to tariff threats and corporate earnings concern. Returns are the lowest among top 10 global markets. This has led to continued withdrawal of FIs from cash market and short positions in derivative markets. What matters is corporate earnings and clear growth trajectory, and nothing else matters. So point is, if the corporate earnings are doubtful and the growth trajectory, again, right now, till now, the good point of India was that it was the fastest growing economy. So now if that point is negated, then the market capitalization also suffers. The other point is that India's bond market is not elated with the S&P rating upgrade. So I'll show it to you again. So if you see here, after the rating upgrade, the bond yields have gone up. Why it is going up? Because bond market does not share optimism of S&P that impact of tariffs imposed by US would be manageable. Proposed reduction in GST and sector specific fiscal support will put pressure on government's fiscal deficit. And after our government bonds were included in the global bond indices, the dollar inflows into debt market have just totaled around 4 billion this year versus 13 billion in the same period last year. So because there is a withdrawal of money from the FIs from both bond market and equity markets, the bond yields have gone up now. So once, what is the implication of bond yields going up is immediately what will happen is that the cost, even if the rate cuts are taking place, the cost of money keeps going up, and it is very negative for the PSU banks because they are the major holders of government bonds. Hence, their M2M losses increase because as the bond yields go up. Now, coming to FI/DI data. So if you see FI's short positions are at still at 1.72 lakh. Now we are reaching the last week of the expiry. On Friday, they have added sold calls, bought puts. So they are FIs are net still net short on the market. Pros are long on index futures. They have bought calls, but they have also sold puts. So their puts which they have sold are at 2.41 lakh, much higher than the index futures positive or the long positions and the call options they have bought. So they are also net short. Against them is clients which is long on the index futures. They have bought calls and they have shorted puts. So that means they are the counterparty in trade to both FIs and pros. So the situation has net remained the same. Now let's see where it goes. Now, if you see here, from 1.85 lakh short positions, the FI index futures positions have reduced to 1.72 lakh. And on the days where they uh, buy puts and they sell calls, the market declines in a major way. It's very simple. Last time also it happened. It declined around 1%. Same thing happened on Friday also. So it is all related to that. Cash buying is of no meaning right now. Now, coming to the US, as we have discussed, US markets this week were headed for a solid loss due to disappointing retail earnings and decline in technology stocks. But on Friday, dovish signals from Fed Chair Powell on Friday led to gains for all indices and the bond yields came down. So if you see here, the bond yields have come down in the US. They came down by 1.53% and maybe headed lower. Dollar also declined, so along with the bond yield, so that should be positive for emerging markets, but not every emerging markets. Brent crude started going up. It was up 3% because there's a news that US own reserves have fallen, so they may be buying more. Gold rose now on Friday as there is going to be more liquidity, so the gold started rising. Silver also rose around 2.37%. It is in a good bull market right now. So if you see the trend, it is higher, and this is a safe investment right now. Copper flat, nothing much happened. Let's see what happens next week, because good liquidity is positive for all the metals, and lower interest rates in the US and the decline in dollar, etc. Bitcoin was coming down, but again, because there was negative news regarding rate cuts in the US, so it was declining, but then recovered most of their losses on Friday. So it is expected to go up if there are going to be a rate cut. S&P 500 made a fresh high, 0.27%. Nasdaq was down because of the uncertainty with respect to earnings or future earnings and capex by the large caps, but it will recover. And next week is Nvidia's result, so that should be another push. Dow was up 1.53%, and so it has made a fresh high. It has broken the last high. So the US markets are doing well. Coming to Indian markets, so if you see here, the India VIX is at generally a below 12, so which is decent, not going up. It went up to 10 and then has bounced from there. Now Nifty, it's very interesting. So if you see 6 weeks of decline, then a green candle, then a gap up. So it has made a kind of doji or a inverted hammer. So we'll have to see. Now there is a question mark. So we have to see what is the follow through action. If it goes up or down from here, there is a gap here. So let's see what happens from here. But the rally got sold off. So the problem is, if you see here, it is making a lower high here. This was the last high in September. After that, it has made a lower high. So if it goes down from here, then it will be negative. Now, if you see on the weekly charts, so if you see the Nifty retraced 61% of the complete fall from the top of around 25,669. It went up to 24,339 and has retraced and it felt it met with resistance at 61.8% retracement. It retraced from there. So now it can either move down to fill the gap, or as indicated, may move up and then come down. So we'll have to see what happens. But this, once it crosses this 61% retracement, then it will go all the way. So we'll have to see what is the price action from here. On the daily charts, if you see, this is the action of Thursday, could be called a evening star pattern. So if the price is straight down from here, then that will show a change in trend. And if you see, the Friday's candle was engulfed all the three positive candles of the last week. So we'll have to see where it goes, but it is poised at a very important support right now. So if this breaks, then next level should be around 650, 700. For the 24,650, 24,700 should be providing a support, a decent support from here. So we'll have to see what happens. Right now, the local news is positive, and it is the second attempt of government at putting money in the hands of people. Problem is from the US side, and if you saw, FIs have marginally covered their index shorts, while DIs are buying in cash, and they are also long in terms of option positions. The other problem is IPOs are causing diversion of funds and attention. So what we need actually is a solid next quarter's good numbers from large caps, so that FI's attention comes back to the Indian markets. Otherwise, it will just remain in this range. So if you see the hourly chart, gap up, then it just was sideways, and then big gap down and decline. So we'll have to see what happens from here now on Monday. Nifty Bank, similar chart. Uh, it tried to go up, but then declined. On the daily charts also, it has come down to that, taking the key support at 100 EMA. So we'll have to see what happens from here. 55,000, and the key reason why Nifty Bank is correcting is because HDFC Bank, it has broken the 50 EMA. So it is now below. I think it is going down because there is a talk about changing the structure of Bank Nifty and reducing the weightage of HDFC Bank and ICICI Bank. which is above 20%. So that is why I think this is getting sold. Reliance was positive, though it fell in the end, but still it tried to go up on most of the days. So let's see. There is a as they have changed the tariff structure of Geo, so that should be positive for them. Midcaps were positive. It shows that there were a lot of retail buying. So midcaps were up 2.35%, and small caps were up 2.12%. So that was the positive part of the market. Now I'll cover two stocks. First is Engineers India. This is established in 1965. It provides engineering, consultancy, and EPC services, principally focused on oil and gas and petrochemical industries. It has also diversified into sectors like infrastructure, water and waste management, solar and nuclear power, and fertilizers. It has reaffirmed FY26 guidance of 20% revenue growth with consultancy oblique LSTK. LSTK is lump sum turnkey. Lump sum turnkey is where a contractor assumes full responsibility for project completion from design and procurement to construction and commissioning. So they are saying that EBITDA margins for consultancy will be 22% and LSTK would be around the 6% in FY26. Now, what happened in Q1 FY26 was that the revenue mix between consultancy and turnkey, because if you see, consultancy is a higher margin business, stood at 48 and 52%. So turnkey was more. Hence, what happens was the stock corrected. However, management expects the mix to shift to going forward, with consultancy contributing around 55% and turnkey about 45%. Now, Q1 FY26 order intake was 1430 crore, with domestic consultancy, overseas consultancy, turnkey mix of 9%, 33%, and 57%. So they are getting more orders in turnkey projects. Now, order book at end of Q1 FY26 is around 12,000 crore. That is 3x, 3.6x TTM revenue. With domestic consultancy, overseas consultancy, turnkey mix of 45%, 11%, and 44%. They are getting a lot of good projects in Middle East. Diversification momentum remains strong, with non-oil and gas verticals scaling to 30 to 35% of the book and guided to 40 to 45% in future inflows, driven by key infra projects from data centers and institutional infrastructure. International consultancy traction is accelerating, with around 960 crore year-to-date intake and visible petrochemical pipeline across Abu Dhabi, Saudi, UAE, and Kuwait. Its maiden rupees 30 crore MOU with Nuclear Power Corporation of India Limited for BSMR, which is Bharat Small Modular Reactor Project, marks a strategic entry into nuclear engineering, strengthening credentials and unlocking long-term opportunities in India's energy transition. So, the reason they are getting into non-oil and petrochemical verticals is because there is not expected to be too much of a growth in this sector. So, because of that, they have to transition. Otherwise, they will not get any other projects. Now, let's see their earnings. If you see Q1 earnings, revenues were up. This is millions, so it was up nearly 39.5%. And for the full year, it is up around 26.7%. It's expected to go up over FY25. It is expected to go up 26%. Margins, if you see here, were flat. But if you see from expectations, the margins are much lower. Then it was expected to be 11% margin. As I told you, turnkey was more and consultancy was less, so the margins were lower. EBITDA is also expected to go up around 27% as the margins decline. Now, was PAT was lower than what was Q1 FY25 and also below what was expectation because of the margins. Though for what is expected is for the full year, it is expected to go up around 15%. And EPS, though higher because of higher revenues, but declined as per expectations, around 20% lower than expectations. For the full year, it is expected to do around 10.2 rupees. EPS. Now the problem was that the in the total revenues, the turnkey projects was higher than consultancy, and the growth was also higher. Now, what happens here is the EBITDA margins of consultancy is around 16.9, but turnkey is just 5.6. So the total EBITDA margins decline because of that. So that is the problem which they have to address in terms of more consultancy and engineering projects and less turnkey projects which are at lower margins. Now, what is expected is, if you see here, the vis-a-vis FY24, FY25 revenues declined actually 5.9%. Though margins had EBITDA was up and EBITDA margins improved. And over the next this year, the revenue is expected to go up 26%, which it should go because they are say if they are counting around 40,000 crore, 4,000 or 3,900 crores, and they have done, if you see here, roughly 870 crores. So they should be able to do 3,900 crore in this year, and they have a 3x order book. Margins are expected to be stable, so they should get a profit growth of around 15%, and over the next few years. So we'll have to watch this, but they are expected to do well, around 20% revenue growth and around 15 to 20% profit growth over a period of time, with margins remaining steady. They're expected to do 10.2 earnings or EPS in FY26, and ROE, ROCE are improving. So they are reaching that 20% ROE right now. So, and dividend yield is also decent because this is a PSU. So the dividend yield is around 2%, so which is good and expected to go up higher. So if you see here, this stock went up after the results of Q1. It has fallen from 250 odd levels to around 190 level, and now it is consolidating here. So if you see FY26, it is expected to around 10 rupees EPS. 10 rupees EPS around this. So at 190, it becomes around below 20 times. So which is okay with their dividend yield and all, and it is oversold right now. So only thing is that how they perform has to be seen, because generally these guys promise more and actually underperform. So just keep this in watch. The other stock is Zen Technology. This is a niche company in the Indian defense sector with focus on simulation-based training for the armed forces. It is also a formidable player in India's counter-drone market, which is forecasted to grow at a staggering around 34.8% CAGR. So it is in niche sectors, simulators and counter-drone. Near-term earning visibility is clouded by delays in order finalization, which may lead to a temporary pause in growth in FY26. So that is the vulnerability, and I'll show you. They are not getting orders. It is the only one to meet the technical requirement for ADS, that is anti-drone system, as it has a capability to search a wide band of frequency which are used by drone and its ground control center. Through its subsidiary Vector Techniques, it makes the core components for drones also. So along with anti-drone, they are trying to get into drones, including BLDC motors, electronic speed controllers, power distribution boards and propellers. It has recently acquired a majority stake in TISA Aerospace, which marks its entry into loitering munitions UAV. TISA is now developing advanced surveillance UAVs for Indian Army, equipping them with real-time intelligence, recce, and target acquisition capabilities. To cater to the naval simulations market, the company acquired 100% stake in Applied Research International Private Limited and ARI Labs Private Limited in February 25. Its IP-led model enables it to earn standalone EBITDA margins of around 32 to 34%. Moreover, it works on an asset-light model, as most of the manufacturing is outsourced. It also generates good service income from AMC of simulator systems. Now, let's see this quarter performance. Year on year, if you see, the revenues declined around 37 or 38%. And Q on Q, the revenues, though we can say the fourth quarter is the biggest. So, despite that, the big dip in revenues year on year, EBITDA also was lower by around 41%. And as the revenue goes down, the margins go down. So, EBITDA margins declined around 3%. Profit before tax was lower, and net profit was also lower by around 30%. So this was the problem, and as the revenues declined. Now, why the revenues declined? So if you see here, FY24, they got roughly 1400 crores of orders. In FY25, because of various other issues, elections and all that, they got around 690 crores of orders. FY26, they are expected to get around 1150 crores of orders, but we'll have to see that. This is expectation. So order book is expected to improve, but this has to materialize on ground. And because of lack of orders in FY25, so if you see order inflows, this is the order book. Now order inflows, if you see, FY24 they got good orders, but FY25 they got around 220 crores, and now FY26 we'll have to see what they get, because most of the orders which they got in FY25 they have executed. So there's hardly any carryover. Now, if you see at consolidated order book status as of 30th June 2025, this is from their investor presentation. Order book as at 1st April 2025 was 848 crores. New orders they got in Q1 was 64 crores. Order executed, they executed 158 crores. So net order book as of 30th June is 754 crores. Includes subsidiaries order book also. Out of this 750 crore, around 100 crores is orders from exports. Now, this is their website. So if you see here, in the last 6 months, they have only secured one order of 152 crores from Ministry of Defense for Integrated Air Defense Combat Simulator. Otherwise, there is no other major orders they have got. So this is the problem. So if FY20, so what they have done is around 900 to 900 crore of revenue in FY24 and FY25. So if they are able to do 900 odd crores, that should be fine. But for that, they need orders also for that, because right now, if you see, their last quarter they did 150 crore and they have 750 crore of orders in hand. So even if they execute all this thing, they have around 900 crore orders. So one has to watch for the fresh orders if they are getting in all, because if you see the trend, last 6 months there is no order as such for them. So what is expected is that FY26, the revenue is expected to decline by 13% over FY25. So FY25 they did 973 crore. It is expected to be lower. So that's what I was saying. They have 150 they have done, 750 is in balance. So 900 they can easily do. So what happens after this is a problem. The reason is you don't get orders now, the competitors come in because it's a lucrative business, there is time, so people get time to develop systems and get technology and all that. While, as I told you, their EBITDA margins have remained at elevated levels, so that is decent. But EBITDA is expected to decline in FY26. So with this, FY26, if there is going to be a revenue decline, they are expected to double their revenue in FY27, but that is not 100% sure. This is what they are claiming, but they are likely to see around 20. They did around 31 rupees EPS in FY25, but have likely to decline to around 26, 27 rupees in FY26. So revenue is going to decline around 13%. EPS is going to decline around 11%. ROE is going to decline from 20 to around 13%, and EBITDA margins are also likely to decline, because obviously if you're not getting orders, you are going to bid at lower prices because it's a competitive field. So now what happened with this stock was It rose in March onwards, and then after the earnings of March, it saw a few upper circuits, and then went up to 2200, 2300 odd levels, and then it was just loitering here, and then based on the results of for Q1 FY26, the stock has declined from around 1900 levels to around 1400 levels after a few lower circuits, and now it is consolidating here. Now, and it was slightly oversold also. So we'll have to see what happens with the order inflow. And you must remember the figure because of orders, how much orders they are expecting. They are expecting at least 1100 to 1200 crore orders in FY26, because some have to be carried for next year also. What will they execute? And if the order inflows is not there, one has to be careful. So I would not really look to buy this stock right now. And in case with market enthusiasm it goes up, I look to exit and then see if it comes down or there is order inflows, then only we will try to get into this stock. I finished. We'll take questions now.